Volta is investing in a diversified portfolio of structured finance assets which provide exposure to cash-generative debt investments, in particular in the corporate space. The aim of the fund is to preserve capital across the credit cycle and at the same time provide a stable dividend stream. Around 75% of the company's portfolio represent collateralized loan obligations, or CLOs. These are backed by a portfolio of levered loans in the corporate space, predominantly issued to sub-investment grade companies. These investments performed well during the last financial crisis, as opposed to collateralized debt obligations backed by subprime mortgage residential loans, which were actually one of the main triggers of the recent crisis. AXA Investment Managers, which is the fund manager of Volta's portfolio, has a very extensive experience across the structured finance space. It aims at generating an alpha of 4 percentage points per annum based on several factors. Firstly, due to the extensive experience and strong relationships, as well as the scale of operations, they're able to negotiate better deal terms with the structuring bank, as well as the CLO managers. Secondly, they follow a very well-defined process in terms of selecting the underlying CLO managers. And also, they very often constitute a majority investor in the respective CLOs, giving them the ability to decide when to call the deal. It allows them also to replace the CLO manager if possible, and also decide about the potential exit strategy. This strategy proved to be very fruitful, as AXA was able to outperform the US dollar CLO equity space by around 5 percentage points in the past. What is also important, AXA IM follows an active investment approach, taking into account the different phases of the credit market cycle. Even though it seems that we are nearing the end of the credit cycle, we think that credit crunch is unlikely in the short term for several reasons. Firstly, the conditions in the global credit markets are still favorable, characterized by a low level of corporate defaults. And we also think that the maturity wall is quite distant, as most of the loans mature around 2024-2025. The fund has taken advantage of the December downturn by deploying surplus cash and purchasing additional assets. In this context, it is also important to note that UK exposure represents only 6% of the underlying portfolio of Volta. Volta's net asset value as at the end of January 2019 stood at around 290 million euros, and the portfolio is largely allocated to US and European CLO debt and equity tranches. The fund has a well-diversified portfolio with top 10 underlying exposures representing only 3.5% of the portfolio's NAV. Volta's annualized return since inception, as at the end of January 2019, stood at 9.4%, and over the last 5 years, the fund has delivered an average annualized rate of return of 11%. Since 2013, Volta was able to deliver an annualized dividend of around 60 euro cents per share, which currently translates to a dividend yield of around 9%. Volta's shares are currently traded at a discount to NAV of around 15%. In terms of charges, the investment manager is entitled to a 1.5% management fee on NAV up to 300 million euros and 1% beyond this amount. On top of this, the fund is also charging a performance fee equal to 20% of the NAV outperformance, subject to a hurdle rate of 8% and an absolute high water mark.